G'day, how's it going? What do you know? Striker like Clayton here from XY Advisor. Just interviewed Chris Brycki of StockSpot. About 4 or 5 years ago, I guess it was, when he first burst out on the scene with this term robo-advisor, and a bunch of advisors sort of freaked out a bit. Turns out that it wasn't sort of the be-all and end-all of financial advice. And what we've seen now is sort of very much a complementary course. Not so much of a collision course, but a complementary course. I don't think anyone would suggest that a robo-advisor will be taking over from where a financial planner could. And I don't think really financial planners have yet figured out a way to give advice to the masses. You know, only 16% of people get advice and 84% remain unadvised. So the market, the size of the market, the size of the opportunity for Chris to sort of get, even if it's simple, financial advice into the hands of millions of Australians, and most advisors would see that as an attractive thing. So we cover how it started, we cover how, he got involved with the chaser and a bunch of cool little things. So hopefully you enjoy. This episode is proudly sponsored by Netwealth. Launching nearly 20 years ago, this ASX-listed company is ranked number one for overall platform functionality and user satisfaction by Investment Trends for the past 3 years. As the financial advice landscape changes, it's important now more than ever to embrace new technology and enhance the way you do business. With this change comes your chance to innovate, explore new perspectives, and realize new efficiencies. Netwealth is here to support you on this journey by providing you market-leading technology, excellent customer support, and expertise to help you innovate in your business. Visit the Netwealth website to learn more and get the PDS which clients should read before making a decision. Products issued by Netwealth Investments Limited. Chris Brycki, mate, thank you so much for coming on the XY podcast.
Oh, my pleasure.
Awesome, man. So you started a fraternity in Texas. I do want to know about this.
That's true. So in my second year of uni, I decided to go over and study in Texas. Now, I chose that university. A lot of my friends were choosing the universities that had the best academic credentials.
Yeah.
With my marks, I couldn't quite get into those ones. So I looked at different lists. I look at the top party schools in the US.
Tailgating, right?
Yeah, and UT, University of Texas, came up in a lot of those lists. So that was the uni I decided to study at. Fortunately, it had a pretty good business school as well, so I learned a thing or two. But something we discovered pretty quickly in our time there was that we weren't getting invited to many frat parties and sorority parties.
Why?
It seemed to be, and our impression was that the Aussie accent wasn't very popular with the American guys because it
was too popular.
It led to more competition than they would have liked.
That is so awesome. I love where this story is going.
We basically got rejected from every frat party, and because everyone was underage, nobody really went out. In Austin, everyone was going to house parties, and we felt a little bit left out.
Yeah.
And there was probably half a dozen Aussies there on exchange, and so what we decided is we could con the Americans into believing that we actually were bringing an Aussie fraternity over from Australia.
Yes!
And fortunately, we had our own house there, so then we put all the signage out front, and we called it, they all have sort of their Greek letters as their names, but it was Alpha Foster's Alpha. And so we had the big Greek letters out the front. If you can imagine the Foster's logo.
That is phenomenal.
And somehow it caught on. So we had some amazing. It basically caught on with all the international students because none of them were getting invited to all of the American parties. So we ended up having all of the international parties that then brought a lot of Americans in because obviously they were interested in all the international boys and girls.
Correct.
We had a lot of fun with those parties that we had there. But what was most amazing to me was I actually went to Texas a year later to visit some friends, and I was out one night on 6th Street, which is the place that everyone goes there, and I noticed someone in a shirt with Alpha Foster's Alpha.
No. Get out of town.
And we hadn't even made shirts. And so I walked up to this bloke. I'm like, what's going on? Where did that shirt come from? And he explained the story of how he'd found out about Alpha Foster's Alpha, and they decided to continue to the fraternity into a second year. So even though we had no communication with the next year of exchange students, somehow they discovered the history of our fraternity and continued it.
Oh my God, that is seriously one of the coolest things I've ever heard. Can we please reenact old school the movie and get it going again.
That is what it felt like. Starting over there.
Is it what is a frat like in the States? Is it literally standing there in your underpants and getting pushed off balconies?
So there's the hazing processes that you often hear about and they get in trouble for, especially at the preppy schools. But it seems like the fraternity was almost like a little club that you join in your first or second year, and there was all sorts of factors that determined which club you joined. I guess what your parents were in, or I think religion played a part, or ethnicity. So everyone sort of found their little niche.
Even ethnicity.
Yeah, so there was like the black fraternity.
Really?
I can't remember what the Greeks were. And the Jewish fraternity. So it kind of segregated people, unfortunately.
Yeah, it's a weird thing, isn't it, how that happens? Anyway, so you actually, before you did any of that, or was this after? Because we've presented at an event together before, and during your introduction, it came out that you'd sort of done really well or won these ASX competitions. Was this pre or post Texas?
The ASX competitions would have been well before, so they were school competitions. So the ASX used to run the
stock market.
I think
games?
They still do the ASX school share market game.
Yeah. So early high achiever. Threw it all in for party life in Texas, right? Get that out of the system, come back to Australia. And how much later was it that StockSpot kicked off?
Well, yeah, I wasn't throwing it all out. Coincidentally, while I was in Texas, I was still, and it was really pretty reminiscent of a bull market, but actually trading stocks while I was over on exchange, which probably wasn't a smart thing to be doing. And I think I only sort of survived because markets were in a very strong bull phase.
Wow,
this was in 2006.
Cool.
So So there was actually trading going on within the fraternity.
Man, that's super cool. So you traded your way through your own fraternity in Texas.
Yeah, it's how I paid for my drinking habit over there.
I have to look at myself in the mirror. I'm nowhere near cool enough to do something like that. Funnily enough, Paddy traveled the world trading gold exchange, gold futures. Yeah, for like 2 years he traded them.
Only gold futures.
Only gold futures. Gold bug worked out for him for a while. A couple of years at least. It was good. I mean,
what's his view at the moment?
His view is don't trade gold futures. I think
he's onto cryptocurrency.
Yeah, correct. Mate, so thank you for coming on. The founder of StockSpot sent a bullet up the advice industry back in 2013, back in 2014, probably more 2014 when we all started learning about it. And all for naught, I largely thought. I don't think the advice industry should have been scared of quote-unquote robo-advice. And as we've seen, it hasn't. I don't know, maybe you've got a different view of it, but I don't see people leaving their advisors. At least I don't see it. Maybe you probably do. But and that's a good question, actually. I'd like to know. How many of your clients have said they used to have a financial planner?
Yeah, well, I mean, going back to your question, I don't think that our business model or other similar models around the world are really going after sort of advised clients typically.
Totally.
And so it seems like some people in the industry were concerned about that at the start. I mean, I think probably the younger advisors that have a different business model and their model wasn't only predicated on investment advice, that they probably didn't worry as much, but there were probably some older school, more broker style advisors.
Did you get any death threats?
No, we had lots of legal threats from the banks in the early days because we published a lot of data on the performance of a lot of their funds.
Was that the Fat Cat report?
Yeah, so we published this.
Oh, you got legal.
Published this report since 2013.
It's awesome.
Yes, I've definitely seen the Fat Cat report.
It wasn't very popular in some circles.
And they offered some sort of legal repercussions.
It was soft legal threats. Yeah, I wouldn't say. Yeah.
No, and I completely understand. Yeah. But it's man, that would make me run for the hills. What did you do?
Well, I mean, we knew all our data was correct. And
I mean, how can you get in trouble for publishing data that's already public?
Yeah, I mean, it was all information that they had to publish. They didn't make it very easily accessible, and I think they didn't like that we made it even more accessible to more people, and we actually highlighted, the performance of a lot of these, these products that weren't helping people. So,
goodness,
might have been the caricatures that put them out off a little bit. These are fantastic.
Yeah, well, we tried to have a little bit of fun. I mean, you guys know superannuation and managed funds isn't the most sexy topic for most people.
Stop it. Have you actually XY party at Dan Blazarian's house tonight?
Well, yeah, you guys are changing that for the better. But generally, for the average person, they're not a lot of excitement. So, yeah, we got the Chaser guys involved as well, and they helped us create a bit of a video.
Do you know them, or how did that come about?
No, we got in touch through a friend, actually, and explained. I mean, they're so good at those types of, those types of, going
satire
after,
satire,
going after sort of,
definitely.
The fat cats in other industries and in other areas of life.
Yeah.
So we got them. I think this was the third year we ran that report to come with us and present some trophies.
It out yet?
No, this is on YouTube, so anyone can search it. Just search the I think it's the Fat Cat Fund Awards 2016, right. Where the Chaser, it was Charles Firth from the Chaser team, came with us to present awards to the worst fund managers in Australia.
Oh, and you actually went to them?
We went to their offices, yeah.
No.
Yeah, we had giant trophies made up and huge novelty-sized checks.
A check of the fees.
Well, the check was how much they ripped off clients by. So we went in and presented it. We managed to convince security at a few of the places to let us in a little way. But then they started to clue on and they weren't too interested in allowing us up to the upper levels.
Oh, jeez.
But yeah, it was good fun.
Did you get in front of anyone senior?
Oh my God.
No, I mean the security is pretty tight. So all of the fund managers that won awards were the big banks, and one other, and they weren't organisations with low security. Let's put it that way. So we got to their lobbies and we lined up at reception
with a big trophy,
with a big film crew and. With a giant novelty-sized check and trophy.
As soon as you see Julian and Morrow, you're like, we're in trouble.
And they would say to us, oh, no, we don't want this award. And Charles Firth was so quick with his response. And he was like, of course they will. They're shameless. They love awards. Like, they'll definitely take it. And he held up the trophy and he said, look, they can fit some Dom Perignon in here with all the fees they've been taking. And, I mean, coincidentally, it's closer to the truth than we would have thought. I saw some interesting articles a couple of weeks ago around the cash management account of one of the big banks and how low the interest rate that account's been paying relative to the salary of the executive that runs that business. And so... yeah, often, true life is a little too close.
Yeah, actually, there's been some things come out recently from the Royal Commission, which always it interests me because they'll pick things that I hadn't thought of, at least. So, such as it was one of the products, I can't remember which one, but it was a super account who was using the cash management account of the in-house super fund, which. Then the trustee got in trouble for not being the best interest duty because it was a decent amount of basis points below. And I thought, actually, to be honest, my first thought, I felt sorry for the bank. I felt sorry for the bank because as if they're going to create a product and use a competitor. Like, I mean, think from a capitalist point of view, that's just not going to happen. What they should have done is, I don't think the argument is so much use Bank B if you're Bank A. It should just be your interest rate should be higher.
But if you're a fiduciary and you have to act in the best interest of your member, which is by law what super funds have to do.
Yes, I know. Well, yeah.
I think it highlights, I think, the biggest kind of issue that's come out of the Royal Commission, which is the issue of principal agent problem. So the problem where all sorts of parties in the super fund industry, whether it's asset consultants or fund managers or financial advisors, in so many cases, their interests aren't aligned with the end member.
Yes. I think from my personal point of view is that, and you may differ in this, my personal point of view is that finance runs pretty well in Australia. Like if you compare it to the rest of the world, do we have places to improve on? And I think that's one that we do need to improve on. So, for example, there are 219 or so RSE, reportable superannuation entity licenses, and 99.5 or whatever % of them are owned by the big banks and by the industry super funds. And so, literally, I think I've got I do have a sympathetic view of this a little bit because even though it's written into law and you're 100% correct, and there's I want to preface this by saying you're 100% correct, but the system as it currently is those RSE licenses are owned by these entities. And so while it's their job to hold that entity to account, they're just going to, the people that are actually doing it, right, the trustee, the people that are working in the trustee, I mean, they're just under intense social, professional, polite pressure to not treat them as if they're a third party. That the only way to fix this issue would be to not allow the entities themselves to own the licenses. That would be the only way, because otherwise, let's say we both work for Bank A and you're the trustee and I'm the CEO of the business. I am consistently saying to you, hey, Chris, how about that trustee? Don't be too mean. That is just happening. And I think to suggest any other is ridiculous. So would you say that RSEs should not be owned by the banks and the industry super funds?
I mean, I think there's other ways to solve the problem. And I agree with you to one extent. I think the industry works fantastically if you work in the industry and are making money off the industry. And it works disastrously if you're a super fund member. And I'll give you some figures.
Where is better in the world?
There's been everywhere, basically. So there's been a fantastic study that's been done recently by a University of Sydney professor who looked at the performance of funds, and we do it every year in the Fat Cat report as well, relative to a synthetic benchmark of index funds. And he's looked at this in all sorts of markets around the world to look at, the average pension funds in the UK, in the US, in other markets. And Australia, from his study, had the worst performance relative to benchmarks and the highest costs relative to benchmarks.
I mean, I definitely have to check that study.
By his estimate, if from 1996 to 2016, so over those 20 years, if all of the superannuation was just invested in a low-cost index fund with appropriate risk and the right cost structure, about $700 billion would be our system would be $700 billion larger, and that would be money in the pockets of super fund members rather than in people working in the industry.
I mean, I appreciate that's a high level sort of headline grabbing number, but there's so much there to consider.
Well, okay,
how much is it the result of a quarter of the superannuation is currently in self-managed super funds? So 30% of that is currently in cash. Like that's going to have a material effect.
No, so here's another stat then. So and this is one that we came up we've found in our Fat Cat report this year, which we haven't published yet, but also it actually mirrors studies that have been done in the UK. So we looked at a indexed balanced fund. So and there have been index balanced funds that have existed, Vanguard since from 1992. So they've existed.
Are you talking 70-30 balanced? Or 50-50?
So Vanguard's is a 70-30 balanced and looked at equivalent balanced funds within superannuation.
70-30 or
70-30 within that sort of band, plus or minus a few percent. So we looked at a like-for-like risk basis and then adjusted the Vanguard fund for fees and taxes to make it apples for apples. And this is a problem I see across the industry. A lot of the ratings businesses don't really compare apples for apples. So if you do that properly, we found that only 4% of funds outperformed the indexed option over the last 5 years alone, and it was even fewer over 10 or 15 years.
Now is that okay? Is that a super fund? Is that an index Vanguard? Is that inside a super fund?
So the fund itself isn't, but it was taxed and the fees were assumed to be within inside a super fund. So we adjusted it to make it like for like.
So what kind of admin fees were you attributing to this Vanguard?
Equivalent to sort of regular admin fees. So looking at their index fund cost, which I think at the moment is about 30 basis points, plus a typical admin fee. A typical admin fee is now less than $100 a year, so it's not significant.
Oh, so there was no percentage base built on top of that?
No.
Oh, okay. So, well, in that case, then shouldn't it be measuring Vanguard plus a superannuation administration cost that is paid by these super funds?
Well, not all super funds have a percentage-based fee. A lot of the industry funds have just a dollar-based admin fee.
If you were so inclined to get that interested in... You're right, but not many people use it.
I'm happy to talk about administration. So we just looked at all of the super funds in Australia, and do you want to guess how much we paid last year in administration fees alone? And this is a system that you say is working fantastically and in the best interest of members.
No, I never said it was acting in the best interest of members.
So do you want to guess?
Say is that it's running pretty well.
Do you want to guess what a system that's running pretty well charges members in 1 year in administration fees? This is administration, so not investment fees. These are people doing the paperwork behind the scenes.
I want to know the FUM. What's the size of the FUM?
1.6 trillion. So this is not SMSF. This is just APRA regulated super.
Not SMSF. Do we take the future fund? Do we take?
No, so that's not included.
Okay, all right. So
it's just regular. The biggest.
Okay, 1.6. Yeah. Give it. Yeah, it's because it's about $1 trillion in the government and
trillion,
SMSF.
It's 1.611 if you want the exact.
Okay, all right. So 1.611 trillion.
Mm-hmm.
I'm going to go with administrative fees of 1%.
1%? So what's that? That would be
don't put me on the spot here.
$16 billion. We pay $16 billion in administration fees.
Look, when you say it like that, it seems absurd.
That's like doing the sums quickly, but that would be like over like $1,000 per member in administration fees. What sort of admin's going on?
Yeah, look, it's a lot, but I mean, it's not equally distributed across, obviously. But,
it's about $5 billion a year, so you weren't too far off.
Right. Well, that seems appropriate. In my opinion. Okay, if you value...
In what world is $5 billion of administration fees appropriate?
Okay, hear me out. Because I'm thinking from a percentage point of view. So if it's only $5 billion and 1 point...
Yeah, so it's about 1/3% in administration costs. But that's another great question. Like, what is the relationship between assets and administration costs? Like,
it's a very good point, considering it's very scalable. Yeah, you put forward a very good point.
These are funds that a lot of them have now, Australian Super's 120, 150 billion pretty soon. A lot of the other big funds are in the tens, if not hundreds of billions. What's shocked me is that they haven't become more efficient on the operational side. So I've looked through the annual reports of a lot of these big industry funds, and actually on a per member basis over the last 10 years, their costs of operations and administration have increased, not decreased.
Per member?
So per member. So there's actually diseconomies of scale. And by our research, actually economies of scale cap out at about $5 billion of assets.
Is that right?
And above $5 billion of assets, we haven't seen any evidence that funds are actually getting economies of scale. If anything, they're getting diseconomies of scale.
Why is that? Do you know? Do you suspect, rather?
Well, there's some great sort of news stories out there of money wasted on building administration businesses. So I think a lot of it comes to super funds, in both sort of the industry and retail super world, deciding to do things themselves that they probably should have outsourced from the start, and who knows why those decisions were made. But a few of the bigger industry funds a few years ago spent, I think, about $250 million on building an administration business, which they basically sold for next to nothing because it was a huge failure. So no one's really worked this out right. And actually, it's probably a great opportunity for technology to solve, and it's one we're trying to solve in our business is how can you make administration extremely efficient on a per member or a per client basis, because it's something
awesome,
that 0.3% of super every year. Remember, that's every year. So every 10 years, that's 3% of the whole money in the system is getting eroded for what? Like operations?
Well, actually, because I'm quite interested to ask where you think that money's going. So let's look at Australian Super, for example. Huge amounts of funds under management. You're saying that their cost per member has increased to serve. If you're in a not-for-profit, right, is it just the case that, well, we've got this money now and we're under obligation to spend it because we can't be profitable? Do you think it's something as simple as that?
Not quite, but I think there's conflicts in all business models. So I don't think industry funds are exempt from conflicts. If you're an industry fund trustee, I believe you should be constantly looking at ways to essentially make your members' outcomes better. And the evidence that we've seen suggests that lower costs is the most powerful way of doing that. But you've got to remember, these are operations that employ a lot of people these days. And so for one of these businesses to actually make people redundant is difficult.
It's kind of an
They
interesting
also
point.
employ a lot
social
of
business,
consultants and other third parties. So just because they're to benefit members doesn't necessarily mean they're efficient, and it doesn't necessarily mean that they're operationally working at the level that they should be.
I want to go back to this $5 billion because It's a lot of money, right?
I thought it was a small amount of money.
Well, it's a small amount of money compared to the size of the pool that it comes from. But I think to your point is what value is being delivered on that $5 billion. I think that's probably more to your point. So I'm thinking, hey, a third of 1% is not too bad. But you're saying, well, what's being delivered on account of that?
To put things in context, like if a third of 1%, might sound small to a lot of people, but a third of 1% compounded year after year after year, we found that 1%, and it's a commonly cited figure, 1% compounded over your life in super for the average Australian. This isn't even a high income earner. For a male, will cost you about $250,000, and for a female, it's slightly less at the moment. But it's not an insignificant figure.
As the average,
that's the difference in your final outcome, paying an extra
1%.
percentage in fees.
Because the average amount of a retiring male is about $250K. So what, half?
So this is looking at an average 30-year-old. I think at the moment has, I think ABS has the figures a certain current balance, and then we're looking at the average salary in Australia and saying, okay, 9.5% of that over the next however many years, 35 years or so.
Okay, so you're talking more projection. I'm talking more the actual outcome. Okay,
yeah. So I'm looking forward. If you're in a fund charging 1% more than another fund,
you can expect that.
You can expect about $250,000 less when you retire. Wow. And a third of percent, might be a little less than a third of that, but it's tens of thousands of dollars, if not hundreds.
No, it's definitely okay. Question then: How would Chris Brycki solve this?
There's a few suggestions. So I actually today submitted I made our submission to the Royal Commission. So it's a lot of this is front of mind for me at the moment.
Mate, that's cool. So literally they're taking submissions on how to fix things.
Well, taking public submissions based on what's come out so far, and this is in all parts of the Royal Commission, but superannuation is the area we're focused on.
Yes.
But they're taking public submissions. You have to sort of reference what's going on. You can't just talk about something completely unrelated.
I started a fraternity in 2006.
Yeah, that might entertain them, but I think they're probably focused on other things at the moment.
Correct.
We'll probably have a beer with them to discuss that later.
Yeah.
Are you able to open the bonnet?
Look, I think generally, and I guess this goes counter to what you're saying, I think the system just doesn't work.
Really?
It's a terrible system at the moment, particularly the default system. So when people make choice, then I think it's a different, it's a different kettle of fish. And when people make choice, the responsibility falls a bit more towards the person making that choice. But most of the money in Australia isn't in choice super. Even though I guess people like us might assume that a lot of people are making choice, but most people aren't making choice.
100%.
It's in default funds.
Yeah.
Now there are fantastic default funds out there,
yes,
but there are also terrible default funds out there. And based on the research we've done, unfortunately, even people having access to more information about what makes a good fund or not. We publish the Fat Cat report every year. We make a big fuss of it. We name and shame the worst funds, but what we've seen is a lot of the worst funds get more and more assets every year. So it's
Everyone's
a broken...
fuck you, Chris.
Can you imagine any other category where there is...
The Razzies. Essentially, it's the Razzies, right? The Razzies of movies. So
exactly.
It's like when Catwoman or Halle Berry got the Razzie for the worst actress ever, and then afterwards sales to Catwoman would spike.
Well, yeah, at least movies is a bit, it's a bit objective.
I've got to find out how bad this is. Invest.
But there aren't many other categories in life where you can sort of empirically say these are the worst products, and yet those products survive and they flourish. To me, this sort of suggests we're in a broken.
When you say worst, how do you qualify that? Because is it performance?
Well, so we look at funds in a equivalent risk category. So we only look at funds with a similar level of growth and defensive assets over set periods of time. Now, I think 1 and 3 year performance is pretty irrelevant because there's so many random factors that come into play.
Yes.
Ideally, you want to look at funds over sort of 10 years plus because then you get to see through a full market cycle. Lehman's went bust just about 10 years ago this week. So you're now missing that part of the cycle, but at least you get some sort of idea.
Yeah.
Our methodology is to look at funds on a like-for-like risk basis, look at their after-fee returns. And then we've done a lot of analysis around, do the fees of a fund give you much, information around how they're likely to perform? And the answer is clearly, yes, like a huge amount of information. Yeah. So the percentage of funds charging, let's say 1.5% plus, that are in our sort of worst list, the bottom quartile,
yes,
is astronomically higher than the funds that charge 0.5% per year that are in that worst list.
S&P do a really interesting scorecard called the SPIVA scorecard, and they talk about survivorship of the top performing funds, which is really interesting. So if you look at the survivorship of the top performing funds over 5 to 10 year periods, it's less than what, like it's statistically irrelevant. It's like if you can pick a winner today, then that's okay, but you'd be unlikely to be able to do that, statistically speaking. But to be able to consistently do it every single year is near on impossible. So I'm keen to learn then, if you're kind of looking at longer term projections and the SPIVA scorecard is saying the top performance is going like this, what do you do with that information? Because it's kind of like what I'm looking at now in terms of a league table.
You pick the bottom one.
Well, yeah. So the S&P, the SPIVA, report card is a great one, and they just came out with their latest one, I think a week or two ago. Their mid-year one, and that basically showed that over 15 years in Australia, 81% of active funds underperformed an equivalent index.
Yeah, wow.
And that's actually quite good compared to internationally, where it's about 90%, or in fixed income, where it's also in the high 80s. So. What they basically say in their report, which is very consistent with what we see, is that the winners change year on, year out. So they might have been fortunate with an asset tilt or been lucky with a fund manager. You actually need a lot of data to see whether a fund manager is outperforming because of skill rather than luck. The statistics actually are that you need 22 years of performance data to know whether a fund manager has outperformed due to skill rather than luck, with a 90% probability.
Jeez.
There's a lot of quite well-known fund managers in Australia that have been around 5 or 10 years.
Yeah.
Some of them have outperformed, some haven't. What I would say is that is still pretty unconclusive as to whether the outperformance is due to something that is repeatable over longer periods of time.
Problem, I guess, for the fund manager is you'd get sacked 19 times in that 20 odd years. If you were smarter than
and that's the other interesting fact is a lot of the best performing funds, that very tiny group that are able to perform, they have huge periods of underperformance, because in order to be in that top echelon, you actually have to have views, and often those views are wrong for a long period of time.
Because they're long term.
And so what I think, I'm not sure if it's a SPIVA study, but other studies have found is that small few percent that end up being consistently good performers, at some point in all of their lives, they're in the worst quartile, and they almost have to be, because if you're actually going to take a view, you're not always going to be right. You're only going to be right over the long term.
High volatility, right?
One interesting study, I read an article on, I think it was the Canadian pension system, and they're like one of the best performing pension systems around the world. Their system's totally different. When you work in Canada, you actually don't get to choose your pension policy at all. It has to go into this one fund. And that means redemptions for this one fund are guaranteed, right? Because Clayton joins today and he doesn't meet a condition of release so I know that I've got his money up until that time. So what that's lent itself to is their largest asset class in that pool is unlisted assets, because they can take such a long view on their investments. They know exactly when the redemptions are coming out, and it's exactly what you're talking about. They've got that benefit of 20 plus years, because you don't have a choice as a Canadian. That money's locked in.
I think they describe that as the liquidity premium, which we know exists in fixed income, and it's sort of debatable in other asset classes. But the Canadian pension system and other sovereign funds are using that. A lot of the Australian funds are doing the same. The only difference is that there's no reason why a lot of people can't redeem out of an Australian fund at one point, in which case there's actually a lot of risk in these funds if they're in illiquid, unlisted assets, because they can essentially be a run on the fund and they can't actually meet their liabilities. I think that's something that hasn't really been looked into in a lot of detail in Australia.
It's an interesting thought, isn't it? Just like if you didn't have to have any liquidity, what does that?
It would change how you invest, and I mean, I know it's an extreme sort of idea, and I did hear you interview a guest recently where I think his idea was that really for default super, competition hasn't worked in Australia, and not having competition would be an idea. I don't disagree with him. I think that's either an option or some sort of system that actually creates price tension. So, what we know is even with MySuper, there hasn't been enough price competition to actually drive prices down to the point where it actually is affecting member outcomes as it should. So we've seen, fees maybe fall from 1.3% to 1.1%. Now, if you have a look at equivalent pension systems in Canada, the US, Chile's another great example, New Zealand even, the costs are closer to 0.3 to 0.5 per year. So we're still,
low.
Compared to other countries, at least double the cost.
Yeah. And that's our admin fee.
There isn't. Oh these businesses in admin are
don't make me defend that admin fee.
But administration's a lot easier if there's one business looking after it and not 50 million different admin businesses. So.
Are you talking about the Houlihan interview?
Yeah.
Yeah, so that was a really good point. So I think if you go back, and I can't remember when it was, but when it was either Commonwealth Bank or it was one of the banks, I think it might have been the Commonwealth Bank before it was demutualised, it set the reserve rate dictated by the government. And so every other bank around it didn't have to stick to it, but there was at least a baseline. And of course, it being the government, there was no premium there, right? Since that time, we've seen an insane gap grow between what is the reserve rate and the current interest rate. And so I guess
what's the reserve rate now? As in, what is that measured by? Or is that the
cash
rate? Mortgage rate or like BBSW? Or?
Yeah, so the difference between the government set rate and then what the banks are charging. Am I just explaining
for
it wrong?
Loans or?
Yeah, correct. Yeah, for a mortgage.
That's their interest margin.
Well, yes, but it's grown a lot. Like that margin has blown out, right?
So that's why they're the most profitable banks in the world.
Hell yeah. which we all own in our super, which is always the funny counter argument, isn't it? Oh, you're getting some of the money back. Don't worry, mate. Anyway,
it's a very strange circular argument, that one. I've never quite worked it out.
Pay $1 in fee and get 6 cents back. What's up, brother?
Rip yourself off.
God, you're brutal. So what I was going to align that argument to before is while I could never, the libertarian in me would never in a million years agree to having a Canadian system where all of our money is just kept in a government controlled and you have no freedom
to do. It's scary, isn't it?
It's massively scary because all it takes is a Pol Pot or a fucking crazy dictator to come in. Excellent, I have all your cash and you can do nothing about it. Not that there's a high chance of that happening, but it is. There's a risk that.
But it's not like this is a new thing. Like it's happening in a lot of countries, and they're doing a lot better than us.
No, totally.
And also, this isn't money that it's like our money that we've sort of saved up. I mean, this is a government-regulated pool of money that the government's created for only the benefit of retirement.
Like, no, it's our money.
It's written into legislation.
It's definitely our money.
It's not a bad point, though. It is a Centrelink proxy. Like it is our money, but it's not really our money. It
is our money. To suggest otherwise is crazy.
Yeah, so it's a defined contribution scheme rather than defined benefit. So it is money that is ours.
Absolutely.
However, the purpose of that money, as written into law, is only for the purpose of retirement.
Yeah, and ancillary to pay for insurances.
And for insurances,
which is always my favourite thing. This is the sole purpose. Plus this extra.
But I mean,
it's like, why call it the sole? Call it one of two.
The concept of insurance relates. It relates to retirement as well, right?
One of two purpose that should be renamed. Sorry, I'm carrying on.
Yeah. I'm lost.
So where I was going to before was on with the Canadian system. I'd be happy to have a government, one that's run by the government, as long as there was choice as well. So I think that was Houlihan's argument originally.
And what do you want choice around? Like the risk that they're taking?
Investment choice.
Like the investments that they're making?
Absolutely, yeah.
I mean, I can kind of understand that from our perspective. We work in the industry, but for the average Australian out there, I think so actually, I agree with you. I think there should be choice. I think people should be out of choice.
Yes.
And if you have choice, you don't need to necessarily invest in the government scheme with choice. So all I'm talking about is default for people that don't want choice.
It's an interesting argument, which was Michael's argument.
And so my argument is for people that don't want choice, people that are defaulting into super.
Yeah.
Then whether it's a government entity or whether there's some sort of auction system that actually leads to better price discovery around what the real price is. Either one of those, I think, is a much better option than what we're currently doing, and I think actually a better option than what the Productivity Commission recommended, which is this sort of top 10 list. I mean, I think there's a lot of flaws that would be seen in that.
So you'd want to see it go down to 1.
Well, the problem with the top 10 list is, first of all, it brings in all the sorts of like politics and all the sorts of problems that already exists. Like, we know from our report that the big banks and AMP by far have the worst funds, but there's no doubt that, at least one or if not a few of those would be represented in that group, even though they absolutely don't deserve to be. But that's just the politics of it.
Right.
But more than that, I mean, what we see is the top 10 list one year changes, and it changes through the cycle because funds that have a tilt towards a certain asset class that does well for a few years tend to look good.
Yes.
Then they get inflows, and we know this across investing around the whole world. But actually, if inflows are actually a predictor of underperformance, not outperformance. And so what happens is funds move up the list, people see that they've done well, they put their money into them, and then those funds tend to underperform unless actually the benefit that they have is actually a cost benefit rather than just a lucky asset tilt, or they selected a fund manager that did well for a while. So what I think would happen would be that the 10 funds that would be selected would be ones with good recent history. However, that good recent history wouldn't translate into good future returns.
Man, so you're a big believer in modern portfolio theory, obviously. Yep. Ray represents a financial planning company that has on its side an additional investment company as well, right? Yep. Can you explain the small difference between just normal passive and then the tilt that you guys use as in trading that passive?
Yeah, so our thing is being dynamic at asset allocation level. So rather than banging on about whether or not CBA is better than NAB, we would prefer to have the conversation a level higher to say, let's have a look at the financial sector and understand whether or not that's attractive or unattractive relative to alternatives at a kind of equal weighted risk calculation. So start at the cash rate, whatever the cash rate pays, let's say it's 2%. Have a look at all the various assets, and then you understand what the future forecast return looks like to understand if there is a premium that justifies taking that amount of risk. Now, if there is, then you do it, albeit to different levels depending on people's risk profiles, and then you just balance it on an ongoing basis. But it's at asset allocation level, so you're actually not getting bogged down in the stock-specific stuff. So it's just a portfolio of ETFs, basically, and I've kind of explained it in a really complicated way. But it's a risk-balanced ETF portfolio that tries to beat cash based on the amount of risk that it takes.
What do you think about that, Chris?
Well, yeah, so first of all, I'm a big fan of modern portfolio theory, but with a big caveat that, like, actually managing people's behavior, I believe, is way more important.
Totally.
And people's behavior and biases, I think, from an advice perspective, is something that advisors need to think about a lot more than what the asset allocation is.
Yeah.
Markovitz, who came up with portfolio theory, he's been widely cited and he's announced in terms of his own portfolio, he only puts 50% in shares and 50% in bonds. Now, this is the guy that came up with the crazy formula of working out the sort of optimal allocation. And even for his own personal allocation, he's decided 50-50 is better because he thinks that's the level that will actually minimize his regret. If markets go up, he won't regret not having something there. And if markets fall, he won't regret having everything in there.
Yeah.
And so I think, behavior is just as important as actually sort of those base allocations.
Yeah.
That's sort of one side. I mean, on sort of taking active decisions, whether it's sort of asset tilts or, stock selection or in any sort of area, I mean, I always go back to my training as a trader. So I used to be a trader and trade stocks, and the people that I sort of learnt from, like my mentors, before I did any trade, they would ask me one question. And that question was, what is your edge? What is your edge over everyone else out there, all the thousands of others of fund managers and analysts that are crunching the numbers and trying to understand what to buy and what to sell? And if you don't think you have some sort of informational edge that everyone else doesn't have, don't trade. Don't make an active decision. And that's what I go back to every time. I question whether I should be making an active decision or whether our client should be making an active decision is what edge do you have? And is that an edge that is defensible that others don't have? Is it an informational edge? Do you have information that others have? Is it a timing edge? Are you getting in earlier than others? And I think, it's a good question for anyone that's sort of looking to trade or pick stocks or make any sort of active decisions in their portfolio needs to think about. Whether, the markets at the moment are at their all-time highs. And I think a lot of investors out there probably are thinking that's great. I'm going to lock in some profits. The market's high. What's actually been shown is at all-time highs, there's a huge tendency for retail investors because of that anchoring bias to be offloading stock. But actually, all-time highs is historically a good time to be buying. And so it's actually a bias that people are falling into, selling at all-time highs.
Yeah, wow.
But if they ask themselves, what is my edge? They'd realize, well, wait a second, I'm only selling because the price is high, but, why am I even doing that?
Why invest?
What extra information do I have that tells me that just because the market's high now doesn't mean it's not going to go higher? So yeah, I think edge is a great question to ask yourself, because if you don't have an advantage over the millions of others out there, remember, information is disseminated so quickly these days in markets. We've got the internet, Bloomberg, like thousands of fund managers that are poring over information, on infinitesimally small time horizons. If you don't have sort of extra information that other people don't have, it's very hard to beat the market.
Yeah, man. A lot of what you say makes a lot of sense. I was sitting in the reception area to get my teeth looked at earlier today, and as I was sitting there, I don't have the TV at my house. Like, I have a TV, but it's only plugged into YouTube. Right. That's all I watch. So it was daytime TV or whatever it is, right? So I'm sitting there, and on comes this, what's it called? Infomercial. It was a live infomercial, a live read, right?
ShamWow.
To the equivalent of, right? And it was this guy, and you could see his eyes reading the script, right? He's pretending to look at the camera, but he's like clearly reading his script, and he's speaking like this. Hi, guys. Just so you know, we've got this product. Anyone can become a trader. And I said, what? And then he went on to talk about grandpas and grandmas who are watching the TV show can sign up to his course, read his book, and then build the life of their dreams. I think his book was 7 minutes of work a day or something to that extent.
You got that from something about Mary, I think.
Yeah, exactly. I'm making a book, 6 minutes of work a day. And I had such an emotional disgust to what was going on that as I left, so I'm sitting there waiting to go to the dentist, and I come out of the dentist. Great teeth, by the way. Great teeth.
Looking good.
Yep, thanks, mate. Clean bill of health. And then the receptionist says to me, you really weren't enjoying what was on the TV before, were you? I said, oh, was I showing that? She was like, yeah, you were shaking your head. And I was like, yeah, because, and I sort of went on a bit of a rant. And I said, it's because you got some retired people at home watching this TV, and this guy's selling them a product that 99.5% of people fail to achieve, which is to successfully day trade. I'm thinking, what? How dare this guy be able to do this in the middle of a Royal Commission? And literally, with that amount of passion, the receptionist behind the dentist said, you could see the look on her face like, I shouldn't have asked.
I mean, it's such a great story, because I think it's one of the big problems with the industry, but more with people's behavior, is people don't want the slow way to riches. Like they want the quick way there, and unfortunately there is no quick way there, but there's a lot of people out there that will tell you there's a quick way there.
Yeah.
And like, from working in this industry, as long as you guys, like you see so many spivs that are selling some, magical system, some newsletter.
I can't believe they can get away with it.
And I mean, again, a question I would suggest anyone that's considering one of these things should be asking themselves is if that system is so good or that newsletter is so good, why aren't they doing it for themselves? Why are they sharing it with me?
Correct.
And it's the same, I think, in the industry for a lot of questions is, if there's a new product being offered to you, most great products and most great fund managers out there don't need to ask people for money. They've closed up their funds because they're so good.
Absolutely.
That they can charge whatever they want. They can have whoever they want as clients. They don't need to ask.
Yeah.
So if you're looking for someone to beat the market, they don't want your money.
Yeah.
Those people, and there is a few of them out there, they don't want your money. The people that do want your money is the people that have a system that doesn't work. And they want to make money from selling you the system. They want to sell you the shovel, not the gold.
Well, and so if I look at a situation where we've got 0.3% is being charged by admin to the tune of $5 billion a year, I'm far
the segue back to...
Well, I'm far less annoyed about that because it's a third of 1% of someone's wealth. Although it is compounding, and I totally get your point. But if we're going to do something about that, we have to do something about this charlatan selling a course that's going to cost someone 70% of their wealth in a weekend.
Yeah, I mean, I don't disagree, and I think that there are so many poor products out there that people will buy. I mean, I think there's a bit of a difference. So, I mean, probably $5 billion worth of money isn't going into that trading system. So, from a dollar perspective, even though it's clearly a lot dodgier than the 3%.
Yeah, it's a bigger
from a dollar
effect.
Value, it's probably having less impact on the economy.
On the economy, sure, but to those individuals,
on retirement balances. But it will have a big impact on those individuals. I think the laws, the laws around advertising financial products try to address that in some way about talking about past performance, what you're allowed to do or not. But yeah, I agree. Like so many businesses get around them.
Something's a service. If this guy was just saying, "I've got a book and a system."
Yeah, I mean, there's a few famous examples I remember from a certain business news channel of people that are constantly on there advertising, their brokerage service or their tipping newsletter that have the same feelings of you. I mean, I don't. Throughout the day, I used to watch that channel when I, worked, in a bank because they have the TVs on all the time. But yeah, so many of those ads frustrated me and angered me because I felt the same way as you. There's all these, people at home watching this, believing the promises and believing the dream. And
it was so bad.
I think it comes back down to as well, like I truly believe, like having, sort of traded and worked in the industry, that the only way people learn, sadly, in financial services is by losing money. And there is nothing so far in my career that has kind of convinced me otherwise. People, whether it's, wanting to trade stocks or wanting to, buy a system like that or a newsletter, the only way people will realize themselves that it doesn't work is by losing money.
It's an unfortunate reality.
It's so sad.
Yeah.
But yeah, it's the hard. I mean, I probably had to go through the same process in my career. Is you test everything out to see if it will work, and you want to believe different things work. But when you lose money, you realize, well, wait a second, there's got to be that's clearly not the way.
I know. I think one of the most valuable things that advisors do is stop people making those decisions. Like mates of mine who have lost hundreds of thousands of dollars on specky stocks, and I begged them.
And I think that's why, the crowdfunding laws that have come out recently, that's why they limited the amount you can invest in a crowdfunding investment, because they thought, okay, we'll let people gamble, but let's not let them gamble too much. And I think conceptually it's the same around the laws that they were some people were trying to pass through on pokies. So, conceptually people should be allowed to gamble. Our society's decided that. But should they be able to put through $100 bills through a machine? The quantum of how much they're able to gamble is kind of the question. And so, I think it would be sensible to have a limit of how much your bet size could be, because that limits how much people can lose. It doesn't mean they can't lose money, and it doesn't mean they can't lose money every day if they don't want, but it kind of limits the harm.
What's the biggest one press bet you've ever made?
I don't think I've ever used a pokey. Yeah.
Seriously?
The stock market was my pokey machine as a kid. Are you a pokey player?
No. I it's a miserable amount. It's like $5, and I'll never forget. I was like, boom.
Can you go higher than $5? I don't know.
Undoubtedly.
I haven't seen a poker machine for a while, but
The most dangerous thing, and I saw it. So when I was 18 and my friends were 18, as you do, you go to the casino because that's one of the places you can go when you're 18.
It's so weird.
And I went with my friend, when we were both turning 18, and I think actually it's kind of led to big differences in our lives since then. So this I think it actually changes your psyche. So I think when the first time you gamble, you lose money, your psyche changes immeasurably for the rest of your life versus if you gamble for the first time and you make money. Now, I went to the casino and lost my $50 or whatever it was, and I've never gambled at a casino since, or maybe once when I visited Vegas, but a small amount. I think you're someone else going through that same experience, if you make money in the first time that you gamble, the kind of emotional high that you get and those feelings that you get and that confidence that you get really affects you. And I think actually the best thing for people when they're gambling or doing anything around sort of speculation is to lose money younger and earlier, and when they have less money, so they learn those lessons on a smaller dollar amount.
Well, so if you go back to when I was 18, I did the same thing, and I was flat broke. But I'd heard that if you sign up at the casino, you get a $10
Oh, that's
free
true. That's
chip.
why we went as well.
Right? Yeah. So I went there.
What a great strategy for them and such an unethical strategy generally.
100%. And you get free membership.
I took that $10 and I turned it into like $80. And I was able to buy, a couple of drinks for my buddies. But I walked out thinking I'd taken the house.
Yeah,
I was just like, yes.
That is extremely good discipline, and you're not a sort of customer they want.
Yeah, I know.
You would not have been invited back.
$80 every time.
Yeah. Like, this guy has way too much willpower.
Yeah, exactly.
He didn't double up again.
Yeah. Oh, mate. So are you moving into advice land? Is that something you want to do?
We've always provided advice. So I don't know how much people know about our business model, but something I thought that we should do from the start, and not all online investment services do, is actually provide personal advice. So we're actually regulated as a personal advice provider.
Yeah, right.
And we give each client a statement of advice, which we review at least annually and update based on people's circumstances changing.
Yep.
So, we see ourselves as an advisor, not around everything.
Sure.
We explain to clients, and we're pretty clear in scoping that we're only providing advice around a small part of their lives. So we're not looking at their insurance or their estate planning, and these are probably areas that we're not going to be focused on, because I don't think they're areas that at the moment we've got any sort of advantage, I guess, for, or I think we can add sort of extra value. But we decided we wanted to provide personal advice around investing, which we do. We are providing advice all the time. We're doing it in a slightly different format than traditional advice.
Do you partner with other advisors? So if another advisor wants to use your product, do you issue an SOA and the advisor issues an SOA, or do you just allow the advisor to issue the SOA?
Yeah, so that's a bit of a work in progress, and I think advisors kind of have a system that they use in terms of providing advice, and so integrating with that has been a bit of a challenge, like working out how that works.
Yeah.
There are businesses out there that just sort of solely do sort of automated statements of advice, obviously, for advisors. Or there's sort of services out there that kind of white label that process.
Yep.
The challenge for us is that because we are sort of regulated as an advisor, we legally have to provide that statement of advice to clients.
Interesting.
So where we've worked with advisors, it's typically not sort of integrated into their software, but as a referral, and then we give the advisor access to view all of their clients in a sort of dashboard that we've built for advisors.
Awesome.
So the clients will still interact with us, and we'll email the clients with updates around how their portfolio is going, and keeping them on the right path, and all that sort of stuff. So we'll provide advice around that part.
Yep.
And the advisor will still provide advice around insurance, or it might be sort of strategic advice or other types of advice.
Yep.
Super keen to learn, because one of the things you spoke about was the behavioural thing, and one of the things that we're focused on at our work is shifting the investment conversation to the side and really focusing on managing the person and their emotions. And one of the struggles for us is working out how to do that in a way where it's scalable and commercial and all those sorts of things. And clearly, technology is a way to do that. Have you sort of thought about how your business can integrate managing the person and the behavioural stuff into that process?
Mm-hmm. Yeah, it's definitely something we think is extremely important, and we see it. We have the data of how many people log in when markets are falling versus how many people log in when markets aren't falling.
Yeah,
so, we see firsthand the nerves, and we see firsthand all of those biases that sort of lead people on their own to not invest well. And so I definitely think, whether it's our type of advice business or a face-to-face advice business, there is certainly a role for advice when it comes to investing. And, there are people out there that say, oh, no, I can do it myself. And I think we've actually got a lot of those clients who thought that they could do it themselves, but then, that they fell for some of those temptations that, they're constantly sort of in people's faces to be more active, or to, pay, more fees for something else, or to tweak their portfolio too often. So the temptations out there for people make it, that's what creates the opportunity for advisors to really kind of be a hand holder and to keep people on the right track. But to answer your question, we're slowly personalizing the experience more. So when we started, we kind of had a one-size-fits-all process. But as we get more data and learnings, we can start to segment clients into kind of client groups, based on all sorts of different attributes. So it could be, how often you log in, or, how often you top up, and all of these attributes help you kind of understand their behavior now, what it's likely to be in the future, what their potential sort of problems might be in the future, and try and be a bit proactive about addressing them.
So the proactiveness, does that work in the way of providing prompts to these people to say, hey guys, we've just noticed that you checked in 5 times more than you usually do, or is it, what is that?
Not that directly. So I mean, an example is, so for instance, when markets have a pullback, so when markets fall 5 or 10%, and I think since we've existed since 2014, there's been one 20% pullback in markets and a couple more 10% pullbacks. So they've been good learning examples for us. What we've seen from those is that clients fit into a few different buckets. One of the bucket that, especially first-time investors, people that have never invested before, that's a whole new experience for them. That they're used to either a cash account that goes up gradually and never has drawdowns, or they're definitely not used to seeing 10 or 20% of their capital disappear. And so those ones we find need a little bit more hand-holding, and you need to be a bit more proactive with. And we write a lot of content and blogs to explain around what's going on in the world. I think a few years ago it was, Greece originally was one of the sort of stories out there. So, explaining to people not only what's happening, but also that, markets are well ahead of this, and that reacting to markets, again, you don't really have any edge in reacting to markets. So there's no, it's a hard thing to explain to people, but, the information's already in the market. So you acting is not a smart thing to do. And then, on the other side, there's also clients that are very experienced clients that have told us when they've signed up with us, I've invested for, 20 years now. I've already been through, the 2008 financial crisis. Some
great question to ask, though, isn't it? It's like, have you experienced market downturn?
That is a great question.
Yeah, so it's actually a question we didn't always have in our sort of joining process, but we've added recently because we've actually worked out that investment experience has a huge impact on people's likely behavior.
Yeah.
And people that haven't, we have clients that are first-time investors, and a lot of clients that have only invested for the last 5 years. Now, in the last 5 years, we've been in a great sort of market period. Markets have only gone up.
Yes.
And so the perception of those clients of what investing is going to be like going forward is very different to a 60-year-old who lost half of their wealth in 1987 and then lost again in 1999. Yeah. So they're a lot more seasoned.
Well, mate, I could literally talk to you about this forever, but it's time to pull it to an end. Mate, how do people find out more or reach out to you if so? And because I know you're quite active on Twitter. So
they can find me on Twitter just under my name, Chris Brycki, or StockSpot. You're welcome to send me an email, just chris@stockspot.com.au.
Yep.
Pretty simple, or visit the website as well.
Mate, it has been so awesome to have you on. Thank you so much for coming on, man.
Oh, my pleasure. Thanks, guys. Thanks for having me on.
Cheers.
Great.